Good morning from our global headquarters in New York. I'm Menace Crenny. You're welcome to Bloomberg Brief. Let's set that agenda. A confidence boost for global risk post-US CPI. Earnings come in strong. That's ahead of the jobless claims and retail sales today. Bessent heads to Capitol Hill. Incoming President Trump's Treasury pick braces for a grilling at his confirmation hearing. And bank earnings continue after a strong round of results. Bank of America and Morgan Stanley on deck. Good morning. Ground zero for the repricing of risk was in the bond market yesterday. We're flat at the moment, 466, but wow, what a day. Down 15 basis points on the 10-year government bond yield. Real yield dropped by 11 basis points. And the market now reprices almost one full rate cut in July. Deutsche Bank raised some flags around the headline CPI being at a 10-month high. Were there real buyers in the bonds or short covering? Stocks took it well as yields dropped. Boom, we had the best day for stocks since election day in November. The Mag 7, furious rally, up 3.72%, and the banks up 4.4%. Tech carries through this morning, up 0.3%. Some of the stocks we are keeping an eye on for you. Richemont surging after the sales unexpectedly jumped 10% in the holiday season. TSMC shares rising after its outlook fueled hopes that spending on AI hardware would remain resilient in 2025. And Applied Materials also rising along with other chip makers on the TSMC optimism. Our guests are lining up in just a few moments. I'll catch up with Kallum Pickering. He's standing by of Peel Hunt. And later in the hour, we'll hear from JPMorgan's Priya Misra and Opimas CEO Octavio Marenzi on the banks. Let's just reflect on the movement in the bond markets. 4 days that redefined risk. 10-year government bond yields, as I said, dropped by 15 basis points yesterday in the US, and the real yield also repriced. Likewise, in the UK, a massive repricing as their CPI and services inflation rolled over. The market now pricing 50 basis point cut there. What does Kallum Pickering make of it all? Kallum, good day to you. Risk took a win yesterday. How do you frame this potential peaking in inflation and a return to the disinflation narrative? Good morning.
Good morning. Well, we can see already it's the bond market that's driving risk pretty much across global financial markets. And when I lean back, that makes sense. Thinking about what the world might look like this year, let's try and thread something through everything we see, whether it's in China, whether it's in Europe, Japan, US. Will policymakers get it right? That's the big question. If policymakers get it right, we can see synchronized growth at moderate inflation. If policymakers get it wrong, then there's a lot of risk on the table. So it makes sense that as markets try to understand what might happen next, we see it through the bond market first, and then that reverberates. What makes me nervous is the big moves on fairly small data point changes. Yes, it's good we got upside surprises on US inflation yesterday, but we're really looking at the third decimal place. If we would have been off by 0.5, then suddenly markets are in line, and we don't get the rally in bonds and equities. I find this an uneasy market.
It's certainly fragile, and the 3-month annualized CPI, by the way, is still at an 8-month high on the headline. Deutsche Bank really do dig into this report. The title of your report is Shift, Shocks and Policy Changes. Today, Scott Bessent is in front of his hearing for his appointment. What is it fiscally that you want to hear as policy evolves from Bessent?
That's a good question. Now, if we just think about the shape of the US economy at the moment, it has really narrow leadership. It's driven by consumer, it's driven by fiscal policy. Trade and industry are weak, parts of real estate are still weak. Now, a good reason why the consumer is strong is because markets are up, people are feeling well off. Part of that is just a conviction by markets that this administration is going to get it right, but they're running a higher wire act. US deficit, it's almost 7%. And so you have this unusual experimental mix of policies in the US, trade tariffs, deregulation, potentially aggressive spending cuts through DOGE. If we see a widening of the US deficit, if this experiment fails, suddenly you see higher yields, you prick the elevated valuations in the equity market, consumers don't feel so well off. So what we need is a conviction that this deficit will remain under control and hopefully heading lower. I think that calms the bond market. I think that calms the equity market. And then I think this consumer and government spending leadership, I think that can remain. But I think it's fragile.
Conviction for the bond market, if the fiscal deficit at the moment is 6% with an extension of the current tax cuts and some, we should be ready for a higher fiscal number. That would say to me the bond market is not done with its exhaustive trade towards the upside.
No, I think that's right. I think the risks in the bond market here are skewed to the upside. It's an unusual mix of policies. Tariffs on their own add to the price level in the US. Tax cuts should stimulate demand, so businesses should have pricing power. On the other side, deregulation and improvement in government efficiency, that should raise tax revenues. It should help control spending. The net effect of these policies will matter. Or, I think, to come a little bit one step earlier, the market's expectation of the net effect of these policies will matter. If we were, over the next few months, to see, say, upside surprises in US inflation data, downside surprises in US economic data, before we even have any major policy changes, that could undo the confidence that's underpinning the upward direction that markets seem to be seeking. That's what makes me nervous. I'm really lacking conviction that policymakers will get it right. It's a big if they get it right, and then contingent upon that, yes, we can have a good year. But I think the margin of error here is razor thin for policymakers around the world.
Look, I think 2024 was about data. This year it's about policy. And the risk is this. We've front-loaded, according to PJ, I was listening to Greg Peters yesterday, we've amped up the positives, but we have decried, or we're trying not to think about with cloth ears, what are the announcements on the 20th of January, which don't take Congress, and they are the bigger negatives. And that is the bigger prick to risk, isn't it?
Yeah, I think that's exactly right. And again, if I just take a somewhat lazy view, all the lines are going up in the US. It's great. Just keep running with it. But as risk kind of goes to the moon, everything always feels fine. But then suddenly you see these kind of Wile E. Coyote moments where you realize underpinning the risk actually is not great fundamentals. A few things I'm keeping an eye on. US savings rates for households, they're extremely low. It's okay. We've got employment growth. There's real income growth. Households feel well off. They're keen to spend. But even a small return to more normal rates of saving would see demand moderate in the US. The US has had for 2 years growth well above potential, 3% annualized. The Fed thinks sustainable growth in the US is around 1.8, 1.9%. So even going back to what the Fed thinks is sustainable from here would involve a significant moderation in momentum. I think we just need to get through the next, say, 3 to 6 months. Let's answer the policy questions. Let's hopefully see inflation moderate. And what I actually need to see at a global level is risk broaden. We need to see good news out of China. We need to see good news out of Europe. That'll provide some buffer against potential disappointments out of the US.
Very briefly, Kallum, in 60 seconds, how ill-prepared are we for a hike from the Bank of Japan next week? The rhetoric is shifting from officials, from Ueda, and from Himanu. How ill-prepared and unpositioned is this market for a hike?
Well, I think we know it's coming. The challenge that we've had is the huge dislocations in the global flow of capital out of places like Japan to the tune of almost $3.5 trillion net into the US to the tune of 21 trillion net in deficit. We only need small proportional moves in these flows to have big effects on pricing. That's what we saw in August. And so even if we get the announcement for a hike and the next day it's fine, if economic data 2 or 3 days later start to go against that call, then suddenly you're going to get moves. That's what happened in August. That's what we need to get through next week.
Okay. Well, we don't know. We really don't want another redux of what happened in August, that tantrum that we had on Dollar Yen. Kallum, thank you very much. Kallum Pickering there of Peel Hunt. Let's get to some other stories trending on your Bloomberg terminal this morning. HSBC is set to cut bonuses for some employees in corporate and institutional banking. That's according to Bloomberg sources. This as the cost of restructuring looms under the new CEO, Georges Elhedery, who intends to take the bank in a new direction. Short seller Nate Anderson said he's disbanding his small but renowned firm, Hindenburg Research. He made international waves in January 2023, publishing a report accusing Adani of pulling the largest con in corporate history. The bearish firm cost many companies billions of dollars. Richemont sales unexpectedly jumped by double digits during the holiday season, a tentative sign that demand for luxury goods may be recovering. Sales soared 10% during the 3 months through December at a constant exchange rate. The news boosted shares, other luxury groups, optimism that the worst may be over for the industry. Coming up, peace at risk. We'll bring you the very latest on the truce in Gaza. That's next. It's Bloomberg Brief. I'm Manus Crenny in New York. President-elect Donald Trump's pick for Treasury Secretary Scott Bessent faces his confirmation hearing later today. The hedge fund manager has prepared remarks on the critical nature of the dollar to the U.S. economy. For a closer look on what we can expect, let's get to Ros Matheson. Ros, good to have you with me. Hegseth had a bumpy, tough day on Monday. Rubio glided through yesterday. What's the focus with Bessent going to be? Is it going to be about dollar and tariffs, I presume?
Well, he's got quite a bit of time to talk about his views on everything. And frankly, everything he is asked about is going to be interesting, as you say. We already know that he's going to talk about his desire for the US dollar to remain a strong reserve currency. But is he going to signal how much he wants the dollar potentially to be weaker? We know that Donald Trump has long favoured a weaker dollar to help US manufacturers, for example. So, what does that come out as in comments today? Also, how is he going to lay out his plan to be able to extend Donald Trump's tax cuts from 2017 while managing the deficit at the same time? Of course, we've got very big government programs weighing on the balance sheet in terms of Medicare, in terms of Social Security. What is his view about debt issuance, for example, in all of that? Does he have a view on the Fed even? Because we know that Donald Trump is not shy in terms of his view on Fed policy and, the personalities at the Fed. Is that something he's willing to wade into? And then, as you say, internationally, what's his view on the very complex and vast patchwork of sanctions that are currently being deployed by the US around the world on companies, on countries, on regimes? And what's his view particularly on tariffs? We know that he's possibly going to push Donald Trump to be slower, gradual in any rollout of blanket tariffs on multiple countries. Is he going to flesh that out in the conversation today? But basically, we know he's going to sail through confirmation. The key thing is what kind of flesh is going to put on the bones of his policy in the conversation today.
Yeah, I think the most interesting is going to be the colour around the tariffs. We understand he is the gradualist camp, perhaps, versus Howard Lutnick. Let's talk about Canada. I mean, they are ready robustly to push back with levies on the US if Donald Trump follows through with his tariff plans. Just how big a plan do they have, and do they have unity?
Well, it's very interesting to see. The most striking thing in this, to me, is that they have a very specific plan already. And that's like a lot of countries probably looking ahead and saying we don't want to just rush and retaliate. We need to have something very specific. We're talking about tariffs potentially on about a third of what Canada imports from the US, and it's a lot. There's no details on specific goods and all of that, but we know that Canada imports a lot of consumer goods, example, from the US, everything from boats to booze. It could all be on the table. What we know where there may not be entire unity from Canada is in the retaliation side. Do they come back by holding back on energy exports to the US? Because, of course, Canada does send energy to the US. It also supplies electricity to the US, particularly in the border areas. Does it wade into those areas? And it seems there's not entire unity amongst the provincial heads in Canada, but certainly a very specific list more broadly being drawn up already.
OK, well, we'll keep a close eye on that. Ros Matheson, thank you very much, our Bloomberg EMEA director. Pivoting to the Middle East, a lot of news flow there yesterday on the ceasefire. And the hostage release deal between Israel and Hamas is now being threatened. The Israeli Prime Minister Benjamin Netanyahu's office is claiming that Hamas is creating, in his words, a last-minute crisis, risking the peace agreement. Let's get to our Bloomberg Horizons Middle East and Africa anchor, Jumana Besetchi. Jumana, this is the Israeli government saying that Hamas are creating last-minute crisis. What do we know of the demands from the Hamas side, and is it a crisis?
Yeah, well, you raise very pertinent questions, Manus, and I think it's worth just stating that after many, many false starts over the course of the summer, it did appear yesterday as though the two sides had finally come to an agreement. You had that statement from the Qatari Prime Minister, who, of course, has been working as a key negotiator to bring the two sides together, and the U.S. also lauding the achievement of getting to this ceasefire agreement. Now, it has not been passed yet by the Israeli cabinet. That meeting was supposed to take place today, but just in the last hour, some commentary has come through from the Israeli PM's office suggesting that they believe that Hamas are reneging on certain elements of the deal. Hamas subsequently, a couple of minutes later, the leader put out a telegram saying that they actually intend to stick to what was agreed in the ceasefire arrangement. Now, in terms of what some of those sticking points could be, if you look at phase one of the agreement, which is the humanitarian phase, that entails the exchange of Israeli hostages for Palestinian prisoners. There have been some reservations on the Israeli side as to what prisoners will be released. And there's a precedent to that, of course, with Yahya Sinwar at some point being a prisoner, was released. And then, of course, we know later on he went on to mastermind the October 7 attack. So there is concern from the Israeli side that something like that could be repeated again if the wrong type of prisoner were to be released. Other sticking points are around Israeli forces maintaining a presence within the Gaza Strip. Many within the Israeli government would like to see an only gradual withdrawal until there's complete clarification that Hamas will no longer have a solid grip over the Gaza Strip. And certainly the international community, the U.S., even Arab states, would like to see a future of Gaza where Hamas are not in a position of governance. But at this point, there are lots of questions about what is going to happen to Hamas in the future and whether they will be able to re-equip and to remobilize again. So these are some of the sticking points. And again, a temporary ceasefire, but still a long way away from that permanent solution and cessation to hostilities.
Yeah, a long road to travel on this three-phase deal that's been agreed. Jumana, thank you very much. Jumana Bessent there in Dubai. Coming up on the show, China initiating a probe into the alleged dumping of mature semiconductors by U.S. firms. More on the story in just a moment. Time now for the front pages. This is what's making news on the New York Times, leading with the strong winds easing in Los Angeles. This as the firefighters make some progress. Forecasters said the current stretch could be almost over, offering a potential reprieve to responders' crews. We're also working to keep old fires from reigniting. Washington Post leads with Blue Origin's New Glenn rocket successfully reaching orbit on its first launch. The rocket's lower portion separated from its upper stage, but the booster was destroyed when attempting to land. Now, the Washington Post is owned by Jeff Bezos, who's also the owner of Blue Origin. And Bloomberg leads with this on China. It's set to begin an investigation into potentially illegal dumping of legacy semiconductor U.S. chip makers. That's according to a statement from the Commerce Ministry earlier today. Tom McKenzie standing by as ever on the tech stories. Tom, thanks for being with us on this. It's just dropped in terms of the news flow. The ministry didn't name any particular company, but who should I think of when it comes to legacy or older chips? What names are in the frames? What do we know about the investigation?
Yeah, Manus, look, names that should come to mind would be Qualcomm, would be Micron, would be Intel. Qualcomm gets about 45% of its revenues from mainland China and Hong Kong. Nvidia, by the way, gets about 17% of its revenues. Intel gets about 15%. Micron along similar lines as well. But Qualcomm is, in fact, the most heavily exposed in terms of the Chinese market and the revenue it gets from that jurisdiction. The details around what they describe or what they define as mature or legacy chips is still being worked out. But this is the Ministry of Commerce in China, as you say, in the last half an hour or so, saying that they are going to be launching a probe into anti-dumping of these, quote, mature or legacy chips being imported from the US market. Number one, this could be a tool in terms of potential retaliation versus what is coming down the pike from the incoming Trump administration. It is also, of course, a response to the additional thicket of restrictions that we've had imposed by the Biden administration just in the last week or so. And it's worth noting that China has had some success building out its own mature chip industry. So it's able to supply a lot of those chips into things like the automaking industry of China that is very chip hungry. It has now built out quite a bit of capacity. Still, China is a major importer of chips as well. So there's two sides to this. They could end up damaging part of their own industry as well, depending on what the results are and how far they go in these restrictions.
I'm going to have everybody IB you and ask you what the word thicket means in the British language. Wonderfully rich phrase. OK, let's talk about the TikTok saviors, the allies. What is it that we've got? A piece of legislation, an act, it's Democratic lawmakers. They're sort of pushing to extend for TikTok. What do we know?
Yeah, I mean, it just seems like everyone's kind of rushing for the exits, whether it's Democrats or Republicans, to try and rework this bipartisan bill that, of course, could see TikTok banned as soon as Sunday. Trump has come out. He says he wants to save the deal. Shou Chew, the CEO, is going to be at the inauguration. He's going to have pride of place, according to the New York Times. Other reports suggesting that, yes, senators, including Cory Booker, have put in place a bill that would see that ban extended by 270 days so that they can reach some kind of deal. Who, whether Democrat or Republican, wants to be the one labelled as the person who ultimately led to the demise of TikTok, which has 150 million US users? We'll see how this evolves leading up to Sunday.
Tom, thank you very much. Great ups on there, Tom McKenzie, on the very latest potential risks for chip makers here in the United States of America. Coming up, she's in the house. JPMorgan's Priya Misra joins me to discuss everything in the bond market. How do you get the fiscal deficit under control as Scott Bessent goes to Capitol Hill for his hearing? Questions for Priya Misra. Join me in just a moment. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Menace Cranny. Let's set your agenda. A confidence boost for global risk post the US CPI. Earnings come in strong. That's ahead of the jobless claims and retail sales today. Bessent heads to Capitol Hill. Incoming President Trump's Treasury pick braces for a grilling at his confirmation hearing. And bank earnings continue after a strong round of results. Bank of America and Morgan Stanley on deck. Can they deliver the glowing numbers from JPMorgan and the rest of the family? OK, to the bond market. Ground zero for repricing. Bonds dropped by 15 basis points yesterday, steady this morning, 465. Was that short covering or was that real money buying? It was hard to find a bull in this market, according to HSBC. Real yields dropped by 11 basis points as well, and that had a consequence for risk. That had a consequence for equities. Roll it over, have a look. Stocks, we had our best day since post-election, so post-November the 5th, we absolutely charged higher, up 1.8% on SPOOs. The Mag 7 was up by 3.72%. As rates rolled down and the real yield rolled down, we rolled into a pro-risk narrative. But let me just show you those bond markets for some context, because this is what we're going to start the conversation with Priya Misra on. 10-year government bond yields, as I say, dropped by 15 basis points. The yields dropped by 11 basis points. There was somewhat of an urgency in the market. Priya Misra joins me now, portfolio manager at JPMorgan. There was all this bullish reaction in the bond market. I put it to you that yesterday was more about short covering than it was about real money buying, because you had one piece of data which forced us to reappraise the trajectory for the year.
No, I agree. I think the bond market has been pricing in a couple of things. Been pricing in this idea that maybe the Fed easing was a mistake. That's why the long end had risen. And then the other big one, the elephant in the room really, is in terms of policy. And I think the bond market, and I would argue all markets, are not looking at this as much as a constrained administration. I think the focus has been pro-growth, deregulation, tax cuts, no real spending cuts. And that's why the deficit fears, the bond vigilantes woke up. I think we were in the danger zone. And so what yesterday did was, at least on that first point, did the Fed make a mistake on cutting rates? No. You know, were they worried about the labor market? Yes. But the confidence of inflation, I think some of that confidence came back. Because, you know, the report is what it is. But you look at the guts of the report, owner's equivalent rent, other component service inflations, telling us we're heading slowly but surely closer to that 2%. I think that was a relief. We still have this big question mark in terms of fiscal.
So the rates market repriced the Fed. We brought it forward. But we're still barely one cut in July. Again, have we gone too far to the left tail risk of virtually no cuts?
You know, I think there's a risk that they do not cut at all if inflation does get sticky. Inflation is notoriously hard to forecast. Maybe it does sort of get stuck at 2.5.
Yeah.
In which case, it's going to come down to the labor market. And that's where I will say 6 months ago, I was worried about the labor market. We were seeing signs of slowing down. That seems to have stalled. The economy is solid. What do we get from this administration? Now, if you get tariffs, I think the Fed, we might be talking about Fed cutting. That's not how the market's trading tariffs. But if it does tighten financial conditions, I would argue the dollar and rates, real rates, you brought up real rates, I'm glad you did that. Much of the move has been real rate driven, which is tightening financial conditions. So then we can talk about Fed rate cuts. But right now, I think the Fed is saying, look, we did the easy 100 basis points of cuts. Now we're going to wait and see what do we get from the fiscal side, from the administration. I think they might be on hold for a while.
So this is the next leg of the bond market. If you want to break lower from here, it's going to depend on what Bessent promises fiscally over these 4 years. He's on Capitol Hill today. Now, I want you to put the probability, or to try and frame the probability of getting from 6.4% of a deficit to GDP down to 3. How hard is that? How realistic is that?
I think it's very hard. I mean, if you look at where we're spending money, where is that deficit coming from? Interest on debt. There's very little that the government can do on that front. Entitlements, such a big component. Defense. There is no political will to touch most of this. In fact, I would argue the only fiscal hawks typically are in the opposition. But the fact that you have Scott Bessent in there, he's a macro investor, understands markets. I mean, I think a lot of what the administration's talking about, there's a political constraint because there's a very slim Republican majority. There's also a market constraint, and I think Scott Bessent understands that. The fact that he said one of his 3 arrows is getting to 3%, I think that's great, because what that means is when they talk about where do we get fiscal easing, they're also going to say where do we cut spending. Maybe DOGE comes in. I think there's low expectations, but is there places where we can cut some spending? I do think that trying to cut a lot of other taxes is difficult. I think all we're going to spend all year is how do we extend the TCJA, the 2017 tax cuts? That's worth $4 trillion. How much do you get on tariffs? How much do you get in terms of spending cuts? Let's try and at least the trajectory, if it starts to head closer to, I think 3 is a very tall order, maybe over 10 years, if we take some really tough decisions. So you see a lot of caveats in there in terms of ifs. But at least as long as it's not going up, I think the bond market's nervous that this was a campaign promise of 3%, but we're going to just go to 7, 8%, and that's why the vigilantes are waking up.
But you're very clear that the vigilantes are alive. They have not died. They're not a dying breed, and that the market will hold this duo to account, Bessent and Trump. You say they will have a seat at the table.
I think they will, yes. I think with every policy, I think this...
Is there a real inflection point in that bond market for you?
I think we're there. I think above 4.5, particularly in terms of real rates. But when I talk about the 10-year above 4.5, I think people start to pay attention. Every market pays attention. Look at mortgage rates. There's interest-sensitive sectors of the economy that will get impacted. The dollar, financial conditions. So I think anything above 4.5, the bond market has a seat at the table. And I think this administration with Scott Bessent understands that. So they're going to be very careful about what they say, what they do in terms of the market impact.
Great numbers from JPMorgan. Yes, I was listening to your CFO. There is no question that we are in an animal spirits moment. Of course, your boss, Jamie Dimon, also very, very bullish. But I want to morph this conversation, the bullishness that your bank leaders see in the US economy. I want you to translate that into credit to sovereign risk. In other words, where I am with duration, should I be longer of bonds in the sovereign space relative to credit, or do their comments reinforce long credit on really tight spreads? That's my issue.
So the market is priced for perfection in terms of spreads. So I agree they're tight, but I think they're tight for good reason. You look at corporate America, I would say even the household balance sheets look strong. Companies are not relevering. So those spreads make sense. I think the spreads are there for income. So fixed income and has diversification. You talk about sovereign duration, that's where diversification comes in. If you get tightening financial conditions, or you get some, I think we're all focused on the positives in terms of the administration. What if you do get, whether it's immigration or tariffs, and you start to see an impact, negative impact on growth, that's where that government duration comes in. So I think high quality spread product, you're getting 6-7%, makes a lot of sense in a portfolio, particularly when you look at every other asset class and you're priced for very strong growth. I mean, I think where a lot of the optimism, animal spirits comes in is in terms of deregulation. And I'm all for that. Let's reduce the cost of regulation on businesses. But does that translate into more hiring, re-acceleration, more business investment? That's what I'm watching in the earnings season. I think the banks are happy. They've got a lot of potential capital. If Basel III endgame goes away, you have deregulation on banks. That's great. Do they return the money to shareholders or do they go out and give more loans? And they might want to, I think banks would love to make loans. Is the loan demand there? And I think that's what we're watching. If loan demand is there, that starts to feed through into the economy, hiring picks up. Okay, that's great. But what if you just get returned to shareholders and we, remain in this sort of soft landing, which is actually not bad for fixed income. Yet 6-7% with low vol. That's a great environment to be in. Fixed income explains why we're getting the flows.
And just to sort of round off for us here, when it comes to the curve, I mean, there was, as I say, a repricing in real yields. A lot of this shift has been to do with term premium. It's to do with angst over the sort of the fiscal issues. This curve is at some kind of an inflection point for me. Where is it for you?
Yeah, I think there's probably a chance of it continuing to steepen, but I think, again, the easy steepening is done. If the Fed's done cutting that front end or close to being done, maybe there's a couple more cuts, that front end starts to get anchored, then it's all about the long end. You started with Bessent. I think I'm going to be watching Bessent on this point as well. He has talked about the Treasury's need to extend duration. I would actually argue, as somebody who looks at the Treasury market a lot, there's more demand for 0 to 5 year. So if you hear from Scott Bessent today that the Treasury should be issuing 50-year, 100-year bonds.
But the market politicized what Yellen did in terms of issuance, didn't it?
I would argue what Yellen did was listen to the market, see where the demand is, and respond. And I think that's what Treasury T-back should be thinking about. I still think the demand is in the front end. There's people in the 0 to 5 year sector. I hope that's where Treasury continues to issue. If you hear from Scott Bessent today that they want to issue long end, that steepening will continue. And I would argue that actually tightens financial conditions. Most of us most of us think about the long end. That's where most companies, 5 to 10 year, that's where households borrow. That's where companies borrow. So that long end is what I think more steepening could be actually a problem for risk assets.
Priya, great to have you with me this morning. That's Priya Misra of JPMorgan. The warnings, you heard them here first in terms of that issuance. Other stories trending on your Bloomberg terminal this morning. This is what we've got for you. We've just been speaking about him. Scott Bessent prepares to sit down in that hot seat at his confirmation hearing later today. He'll emphasize the importance of maintaining the US dollar as the world's reserve currency in his prepared remarks. The remarks that Bessent's first public comments since Trump nominated him, where he'll play a key role in implementing sweeping economic policy agenda. Prime Minister Netanyahu's office says that Hamas has reneged on parts of the Gaza ceasefire and hostage release deal, and that had already been agreed upon and is creating a last-minute crisis that prevents its completion. Now, the deal aims to pave the way for a permanent end to hostilities, with the talks to follow on the release of remaining hostages. Hamas says it is committed to the accord announced by mediators. HSBC is set to cut the bonuses for some employees in corporate and institutional banking. That's according to Bloomberg sources. That says the cost of restructuring looms under the new CEO, Georges El-Hedari. And he intends to take the bank into a new era. Coming up, we'll talk more about the banks. Octavio Marenzi of Opimas joins me after yesterday's blockbuster bank earnings, and we look ahead to Morgan Stanley and Bank of America. Context matters every day on Bloomberg. It's Bloomberg Brief. A very good morning to you. I'm Manish Cranny in New York. Dollar yen definitely on the march. Yen marching higher against the dollar by over 0.5%. Likewise, the euro repricing. What we have is a very hot hike risk on January the 24th. Bank of Japan officials now acknowledge the likelihood of a hike. This is sort of the third arrow. Ueda has confidence in wages, the highest since 1990. Then his deputy, Himeno, also hinted at the risk of it being a hot meeting. The narrative from the Bank of Japan officials in the past 24 hours is that barring any surprises from Donald Trump, well, everybody should be prepared for some surprises there. They probably will upgrade their projections for inflation. The question is this: how positioned is the market in yen? Jordan Rochester of Mizuho says the positioning is almost non-existent. This market needs to catch up to the idea that a terminal rate of 1% could be on the cards. In terms of the assets in the market this morning, we just finished a conversation with Priya Misra of JPMorgan. She's worried that any bond market over 4.5%, the vigilantes will have a seat at the table. She wants to hear from Scott Bessent in terms of, A, where will you potentially issue on the curve? Should it be at the shorter end of the curve? That is the question. Will it be at the short end of the curve? Listen to the market. That is what she is saying. And in terms of the deficit, that's also critically important for this market. How do you get from 6.4% to 3%? The promise. It's a tall order. A little bit of breaking news for you coming from BP. BP are set to cut thousands of permanent contractors on the job. So this is the very latest breaking headline. Thousands of permanent and contractor jobs are to lose their role with BP. It's Bloomberg Brief. I'm Menace Crenny in New York. America's biggest banks on Wall Street, they're ending the Biden era on a high note. Yesterday's Big Four, JPMorgan, Goldman Sachs, Wells Fargo and Citi notched up their second most profitable year ever in 2024. Their first most profitable was Biden's first year in office, the halcyon days. This morning, we'll get the results from Morgan Stanley and Bank of America, rounding out some of the biggest names. Octavio Marenzi is the CEO, the co-founder of Opimas. Octavio, great to have you with me. So, a blowout day yesterday, very much on the investment banking side, fixed income, commodities and currency. Are you seeing the risk for that to continue throughout 2025? Let's just set up the agenda on the animal spirits.
Well, listen, you and I know that markets are very difficult to predict, so I'm not going to go on the record of predicting what's going to happen in investment banking through the end of the year. Those numbers tend to go up and down a bit, so I think that's a bit of a fool's errand to try and even predict that. What I will say is that it was a fantastic quarter for trading and for investment banking in particular at most of the banks. Wells Fargo, a bit of an exception, didn't see such strong results on the trading side, though everyone else did, but investment banking very strong. The business that did show weakness was basically the retail banking and corporate banking side of things, but nothing dramatic. So there were small declines there in terms of lending levels, small declines there in terms of net interest income, but nothing terribly troubling. But encouragingly there too, we did see credit quality remain very high. So there were no problems in terms of lending portfolios, no major risks of default. So that was very, very positive. So I think overall a really good quarter, particularly on the market side and investment banking side and retail banking and wholesale banking trading a bit.
Do you think it's a fair assumption then? I do realize there's huge volatility in investment banking and FICC. I've been around a while. But if you have a deregulatory Trump policy in place, it's expected to reignite IPOs, bring more deals to the table, debt and equity capital markets. It's a fair assumption that we'll have a strong 2025.
Definitely on the regulatory side. I mean, I think you're absolutely right. I will say last time Trump won the election back in 2016, I think all expectations were that certain sectors were going to do very, very well indeed. So we all thought that, well, financial services is going to do fantastically well. And energy, too, was another sector that we thought was going to do very, very well under a Trump administration. Now, he did slash regulation. He did take a lot of the roadblocks out of the way. He did reduce taxes. And those things were all very positive. But if you look at the performance of those two sectors, the sectors we thought were going to benefit the most from a new Trump administration, they lagged the market by quite a bit in that first year. in the first couple of years of its administration. It didn't do that well. So maybe we'll see a repeat of this, but I think all the indications are favorable. Yes, we should see that continue. We'll see, I think, far less antitrust risk. I think a new boldness in terms of going into new mergers and acquisitions. A question on the horizon, I think, are interest rates. That's going to be the major factor, I think, overall in driving those things. And that's really, I think, what we need to be watching is what's the Fed going to do next and how are they going to move. And for the time being, I think the best indication now is that they're going to sit on their hands and do nothing now, basically, for the remainder of this year. That inflation has not come down as much as they'd like. It's been very, very stubborn, much higher than they thought. Markets are very high. Unemployment is still doing really well and new jobs being created. So there's not much impetus for the Fed to cut rates further. So I think they're just going to do nothing for a while, and that is not going to necessarily help those activities that much.
Well, there's barely one cut priced in now for July this year. This was the first quarter we saw reports with the Fed cutting. And the delta, the consensus is, look, the delta is net interest income. JPMorgan guided at 94 billion. How did you interpret that? You're not just as bullish, perhaps, as the rest of the market for the year on NII for them, are you?
Well, I think I actually am quite positive, because what we are seeing now in terms of net interest income is a steepening of the yield curve. And that's just basically happened in the past couple months or so. So there was some impact there towards the tail end of the fourth quarter, but we're going to see the full impact of that. And of course, as you know, banks, they borrow short, they lend long. The steepness of the yield curve is their net interest income. And so the steeper that yield curve becomes, the better it is for them. So what we're seeing right now is that very short-term interest rates are not really budging, not really moving, maybe even going down a bit. As you pointed out, they sort of factored in another rate cut for the Fed funds rate, so the overnight rate. At the same time, we're seeing 10, 20, 30-year yields where a lot of people borrow money actually going up quite significantly. So that's going to be good for net interest income. Now, it's never that simple in the banking business. I mean, a lot of these banks hedge interest rates in all sorts of very sophisticated ways. So they tend to not just take a naked exposure against the steepness of the yield curve. But that is the underlying factor. That's the underlying factor that's going to push them. So I would expect to see an improvement now in Q1 if those interest rates steepness persist, and I expect it will. So I'm actually quite bullish in terms of a slight increase now in net interest income in Q1 of this year.
Well, certainly it was a heady day yesterday in some of the guidance. Michael Barr's version of Basel III, known as the end game, probably won't be implemented. We've done our Bloomberg analysis, $124 billion in excess capital. Give me your take. Is that a buyback bonanza? Is it a special dividend bonanza? Or is it, look, excess capital, get out there and lend it and make it work, get the ROE up?
I think that's going to vary tremendously from bank to bank. But I think, we're going to see banks in general put that money to work and try and find new opportunities to either lend that out or lend. But I don't say that banks have maxed out in terms of the capacity of lending, but I think we're not far away from that. There's just not that many good opportunities to lend more money out. So I think they'll be looking for other ways to put that money to work. And yes, some capital returns to shareholders, absolutely possible. But I think they'll be looking in the markets to invest and expand in other areas and buy up and go through some mergers and acquisitions of their own, where they're looking to actually buy and acquire other banks. I think the Trump administration is going to be much more open to that, and we'll see I won't say a bonanza, but there's still a lot of regional banks in the US, a lot of small institutions that really are going to be in the cross sights of the larger banks looking to put this capital work, and acquiring other sort of regional mid-tier banks is going to be a very interesting way of doing that. So I would expect a strong activity in banking mergers and acquisitions in this coming year.
Octavio, thank you so much. Octavio Marenzi there of Opimas. Your thoughts on the banks. We're counting down to those results from Bank of America. This is your slate. This is how it looks. Bank of America and Morgan Stanley both up before the market open. We'll also get retail sales and jobless claims at 8:30 a.m. Eastern, plus the confirmation hearings on Capitol Hill, including Scott Bessent for Treasury Secretary. That's it from Bloomberg Brief. Surveillance is up right ahead.